really far with the question, what do we mean by finance and what the financial system does. And probably this picture is useful, and probably after all of your studies and a couple of days here, it won't surprise you too much, but probably it's still useful to start from here. So basically what we usually say is that what finance is doing is that it connects the savers who are supplying the capital with the users of capital. Okay, so basically in a macro model, what they do is that they make savings equal to investment, which sounds like easy enough, but of course it's not easy. So the hard part is that those households know very little what they should really know to decide whether to give money to those investors or not. So, you know, if you think about this, I mean, any example you think of, there is Facebook. Facebook is developing new cryptocurrency. So the question is that whether Jane, who is a graduate student in one of the US institutions and just started to save for his new flat, whether he should save by investing in Facebook. And this is really not an obvious question. Jane probably knows nothing about this cryptocurrency. Probably Facebook themselves know nothing about this cryptocurrency. It's a stochastic flow of payoffs with an unknown distribution. So how we should convince Jane to give money to Facebook, and what is more, what should be the terms of that investment? What should be the price of those shares? What should be the expected return on those shares? And how should we make this happen, right? So this is really not obvious. And pretty much this is why we have all of these guys in the middle. They somehow are there to make this job. Sometimes they are there to somehow figure out what are the terms that everybody is happy and savings are going to investment at the end. So there will be a lot of repackaging of the risk. There will be a lot of risk sharing in the middle. There will be a lot of valuation, and somehow the whole thing works out. Okay, so that's basically what we are after. We try to figure out that how this thing can work out. So we have so it either goes through the markets or it goes through some intermediaries, and possibly intermediaries are pushing this through the market first before it goes to investment. So this is the standard way how, say, finance started to think about this problem. And probably you saw that before. Probably Yarda showed you something very similar. Probably you saw that before in your graduate courses. But let's just start from here. So this is basically the standard saving investment problem. This is Micro 101. There is this representative agent who decides he has some endowment, right? And he has some endowment today, he has some endowment tomorrow, and there is this asset or portfolio which gives some random payoffs. And then he wants to decide how much to invest in this portfolio, which will give the future consumption, and through the price what he pays for that investment gives his current consumption. You solve for the first order condition, and you get a standard Euler condition. And this is the basic asset pricing equation. So this is usually this is what we call asset pricing, that there is a price and there is a pricing kernel, and that pricing kernel translates payoffs through the expectations to prices. Okay? So what is probably I will try to have some feeling of background. So can you just explain me what is the intuition behind this equation? I'm just kind of want to try to have a feeling whether this is something which you saw 1,000 times or this is the first time when you see this. Hmm? Yeah. So can we chat about this a bit? So what does it mean? What is a pricing kernel? How does that work? Yes. Exactly. So at the end of the day, this is an indifference condition. So you can think of this as an indifference condition. This is just the price at which a marginal amount of money which you save gives you exactly the same utility as a marginal amount of dollar, a marginal dollar, which you consume. And for that, you have to use, the critical question will be that what is the marginal utility of that consumption today, and what will be the marginal utility of consumption tomorrow, and this ratio basically gives you that pricing kernel. Now, often we make a little bit of transformations, which I won't do step by step, to get this expression instead. So this is an expected return equation. How do we talk about this usually? So we have covariances here, we have a pricing kernel, we have returns, and we have expected returns on the other end. Does it ring you a bell? That's fine. I mean, if it doesn't, it's perfectly fine. I just want to know whether it does or not. So it's
That's the condition, right, that links the risk premium with the covariance with respect to the to M. So usually it's with the market or like with the stochastic discount factor.
very good. So basically, this is you can read this as a cross-sectional equation. So that just tells you that different assets which assets should have high expected returns and which assets should have low expected returns. So which of the assets should have low expected returns according to this equation? Exactly. So basically, the idea is so the way you think about this is basically how you think about insurances, right? So you like those insurances which pay you when you need it the most. So you buy a car insurance because it pays you exactly when you break your car, and when you break your car, you really need money. So this is the same thing here. You will have a high expected return for those assets which have a low covariance with your marginal utility, which basically means that those which pay you when your marginal utility is which pay you when your marginal utility, when your consumption is really low, which is when your marginal utility is really high, right? I hope I said it in the right direction. So basically, returns are low when you get the money when you don't need it, and this is when your marginal utility when your marginal utility of money is low because your consumption is high anyway. Right? So this is kind of the idea. So far so good. So this is asset pricing. Okay, so that's kind of the basic model of asset pricing, and this is where we want to start. So later we will refer to the continuous time version. So I just kind of put it here. So when you look back in your notes, you know where this is coming from. So I will just refer to these equations later. But it's basically the same equation, just with a tiny different notation. Okay. So this is actually it's a very interesting equation. It's extremely parsimonious, right? So basically, if it worked, that would be wonderful, right? It would make our life super simple. It needs very, very little ingredients. It needs basically what it says that if we want to know what is the right price for Facebook, the only thing what we need is a pricing kernel, which is basically our utility function, some expectation about our consumption, the payoff, and expectations, right? So basically it says that if you have these objects, you have everything. You know exactly what is the right price. Now, the other thing what it says is that basically in this very simple setup, trading is not really important, right? So whenever any of these objects are changing, price jumps to the right level and everybody is happy. So the financial market itself doesn't really play a role. The trading process doesn't really play a role. So in this equation, there is no such thing as, for example, if you are coming from economics, what might surprise you that in this equation there is no supply and demand. So usually we think about prices as supply equals demand. In this equation, it's not really clear who supplies what to whom. It's just the price always jumps to the right level. So there is, which basically means that there is no feeling of price pressure, for example. So there is no feeling in this equation of if I want to sell a lot of assets suddenly, then I will get a worse price than if I want to sell only a tiny bit of assets. There is no slope of demand and supply curves, what we are usually used to in economics. So this is an interesting equation. And finally, what is really important about this equation is that it connects two variables. Yes?
So I'm not sure I entirely agree with you about this.
Oh, okay, we will debate.
If you tried to sell a lot to this guy, marginal utility would go down, and so you would have.
Well, the thing is that, of course, I mean, if you are really, really big, that might be true.
But this is the representative consumer, so if that's true for everyone, you get a lower price.
So usually the way we read this is that this is just aggregate consumption, which we observe in the data, and this is all the prices. So in principle, just because you are selling a lot of stuff, aggregate consumption is not changing. So, and that's the last point what I wanted to say, is that usually the way this equation is used is that it connects aggregate consumption with all prices, two things which we can observe, and so this is essentially testable equation. Yes?
If I have two consumers who are different and together they have this utility function, but they have different preferences to different states of the world, then what will happen, even though it's a complete market, what will happen is that you still see price pressure and all the stuff that you're saying that you do not see. That's because you have two different
Yes. So in a moment, I agree. So you can expand this model, and then you can include all type of stuff. At some level, yes, but there will be, different utility functions. You have to aggregate this somehow. But this is, okay, so probably I put it the wrong way. I just want to start somewhere, right? So I won't tell you that this model is useless. It's a very important and useful equation, and we can expand it many ways to make it useful. But it's, so as you will see in a moment, so give me a couple of slides and we'll talk about this. So I didn't want to oversimplify this. I just wanted to give you the idea that it's a very simple equation with, if you look it as it is, with some limitations, but it would be wonderful if it were. So usually so let's just check whether in itself, without any bells and whistles, whether what it does in the data. So let's just do something very simple. So let's make this utility function CRRA. So that's it. And then we can substitute into this expected return equation. And now we kind of know everything. And we can check that whether we can choose. So this is aggregate consumption. These are returns of all type of assets. In principle, it should work for any assets. And one thing what we can do is to try to find some parameters, any parameters, for which it works. Okay? So basically, the way you do it is that one way to do it is that you form some portfolios according to some characteristics. You check how they cover in time with the pricing kernel which you calculate from the from aggregate consumption. That gives you some covariance terms, and that should be your betas. And then the question is that whether expected returns are proportional to these covariances. So basically, the question is that if one portfolio has a high covariance with aggregate consumption, as you calculate this way, whether it has a low return or not.
You're pushing the same problem to rational expectations which are in people's heads. You never observe those. You make assumptions.
Oh, okay. No. I'm not even want to go there. No, we are not debating this model. It's an introduction. It's the first slide. I just want to kind of give you. This is exactly what I. So in the next slide, I will tell you this was how we understand in the 80s, and then came 30 years of research.
That was around the 80s. We never
Okay, this is how we wrote down at the beginning, and there was 30 years of research, and we figured out all type of stuff, and everything became very nice. But that's. I'm not debating this equation, okay? So this is Cochrane chapter 1, and I'm just kind of starting from there, okay? So if you want to take it on with him, that's fine. Okay, so this won't be our topic. I just want to start from somewhere, okay? So, so here is how it looks, okay? So, so this is. These are 10 portfolios. These happen to be the size portfolios. So each of these assets are corresponding to a different size of stocks, of firms. And then this should be the predicted expected return according to this model. And these are the data points. So is it good news or bad news? So it's bad news, right? It's not. So the problem is, I mean, the good news is that there is something. Actually, I mean, it could be nothing. It could be like no relationship at all. There is some positive relationship. That's the good news, but it's way not enough to. So basically, the difference in covariances, the way you read this, is the difference in covariances is way not enough to explain the different expected returns in these portfolios. And actually, this is the best possible parameter. So this is actually 241 gamma. So it's a huge. You need, even for that, you have to blow up the significance of this consumption quite a bit, and then it gives you that. So okay, so this is high. This was 30 years ago. Okay, I mean, probably even good things that even 30 years ago it wasn't that simple. Probably it was 50 years ago, whatever. So and I will argue that basically since then asset pricing went to two separate directions. So this was kind of a problem. This caused headaches to researchers. And one direction was exactly what you started to explain, is to refine this problem, to give some bells and whistles to this problem, and I think Yarda told you about some of those, and so basically there has been a long list of refinements, more sophisticated utility functions, innovative consumption dynamics, heterogeneity in preferences, as you said. Better measurement of each of these variables, and so on and so on. So there was a long list of refinements. This literature, it's a huge literature. This literature has a very strong quantitative emphasis, so it's really want to get those numbers right. And they did manage to get many of the numbers are right. And this is not our topic. Okay, so this is the direction where we are not going. Instead, there is another direction, I will argue, which basically, instead of refining the problem, decided to change the problem. Which basically means that they gave up on some parts of this problem. Namely, they gave up on connecting consumption to prices. My interpretation of this is that it's just too far, right? So household consumption, you know, the representative household in the US not even investing in stocks. They are probably have only bank accounts. Some of them are investing in stocks, but even then they are not doing it directly. They are doing it through their pension fund. Or they invest in the bank account. And then banks invest in stocks, or banks invest in some kind of product which invest in stocks. So the distance between consumption and prices are very big. And possibly, and that was kind of that idea was raised. Probably it's so far that it's just very hard to see that there will be a connection at any point. At least it's worth an effort to do another way, right? So instead, the idea is that we can zoom in to the market and try to see a little bit more seriously what is happening on the market, who trades, why they trade, what they buy, when they buy, what they sell, and so on. So kind of like zooming on, like trying to understand a little bit what happens actually on the market. And from that, once we understand something, we probably can zoom out again and try to build an asset pricing model which is based on different premises. So this literature produced, so one way I can, so what I like to call it is like asset pricing with frictions. So it focused on many impediments in this process. Asymmetric information, market structure, whether it's an OTC market or a search market, intermediaries, incentives and constraints of different participants. And actually you will hear many of these, about many of these in different lectures in this week. So Jose will talk about the, well, okay, so a lot of new topics came in because of that. Mispricing, bubbles, crashes, speculation, liquidity, trading volume. All of this doesn't really arise in the standard model. Probably you can put them in somehow, but really it's not the focus. So Jose will talk about speculation and bubbles and crashes. Yuli will talk about how all of this translates to the macroeconomics. And I think Ben will talk about learning. So a lot of things will come up. And up to recently, this literature had rather a qualitative feel as a quantitative feel. And I will go to the quantitative side at the very end, but you will see that it's it's really the first steps. So what I want to do today is to look a small slice of this approach, a very, very small slice. Okay? And probably this is the right time to kind of tell you that what is the limitation of this talk today. I won't give you a review of the literature. I won't give even the review of the literature of this small slice. Okay? So basically my main objective is to give you some kind of arc of thought which started somewhere here and arrived to somewhere where we will arrive. And I picked a couple of papers to demonstrate this arc of thought. Yes, so and we'll go there. Okay, so here is where I want to start. So we'll start with limits to arbitrage, and I will tell you why we do that. So what is arbitrage checking? What do we call arbitrage trades? Yes, yes. So the way finance theory works, at some parts of the finance theory, is that you say that a central idea is that if there are two portfolios which have the same distribution of payoffs, the same stochastic process, those two portfolios should have the same price. And if they don't, then you buy the cheap, sell the expensive, and make profit, right? And because they have exactly the same distribution, that should be safe. And the idea is that if it's safe and you can make money for sure, then these opportunities should not exist, right? So the no free lunch, this is kind of the no free lunch idea. At least this is, in a pure finance, this is how it starts. So arbitrage is really the central mechanism, one of the central mechanisms in finance theory. It should keep prices at their fundamental level. Still, in reality, there are a lot of arbitrage type of trades which hedge funds and intermediaries are routinely doing. Okay? So the way we define arbitrage type of trades is that this is a long-short position of two portfolios which are generating near identical cash flows. And because by arbitrage, their prices should converge. And you are doing a long-short position because you are selling the expensive and buying the cheap. So the reason why we kind of focus on this is not because these particular anomalies themselves are super important for us. You know, it's very important for hedge funds who are making money on that, but you know, I mean, it's not necessarily important themselves for the big picture. However, we usually use arbitrage trades as guinea pigs in financial economics, okay, or crash cart dummies. And the reason why we kind of like them, because more often than not, we don't really know what is the fundamental value of an asset. It's very hard to know that where the price should be. It always depends on your asset pricing model. And then whenever you kind of identify a mispricing, you're just saying that my asset pricing model doesn't work in that prices. With arbitrage trades, at least we know that the relative price of these two things should be the same. So we have a very clear benchmark to think about. And that's why we kind of like them. So the way we think about them is that it's kind of a minimal requirement that our theories are explaining that why we have gaps between very similar portfolios if there are. So it's kind of like it's a very clear example of something going wrong. So we want to use our models to explain that. So let me give you one example of that. There are many examples. So this is the treasury inflation. This is the TIPS treasury arbitrage. So TIPS, do you know TIPS? TIPS? Yes, so basically this is an inflation-protected bond. So basically it's a bond which the US Treasury sells, which should give you more when inflation goes higher. So in real terms, you're always getting the same coupon. So it turns out that you can create a synthetic, using TIPS and some derivatives, you can create a synthetic treasury, right? So basically what you can do is that you can buy a treasury inflation protected security, a TIPS, which is paying something which is proportional to the inflation. And then there are derivatives which you can translate that inflation, you can swap that inflation into a fixed payment. So together, the TIPS and the derivatives together gives you a fixed payment. And this is just as riskless as treasuries are. At least there are no more risk in those combined portfolio than in treasuries. So they should have the same price. And it turns out that the synthetic treasury is usually cheaper than the real treasury. So this is kind of a picture of that difference. It is also observed that this mispricing is getting worse when arbitrageurs, when I say arbitrageurs, you should think about the smart money, like hedge funds, trading desk of intermediaries, so those who are supposed to be very sophisticated investors. So whenever they lose money, this tends to be worse. And what is more, it covers with many other arbitrage-like trading strategies. So this is a list of them, but there is, if you go there, there are a lot of references about it. Yeah.
Can I think about it instead of arbitrage? Can I say that there is some risk that they are loading on
Sure.
without knowing?
Sure. So that's why I'm calling them near arbitrage trades. So, so if you look closer, and that's again a line of research, usually there is a reason why these prices are not the same. In this case, people argued that there is a convenience yield on those treasuries. And also there can be risk because of the trading process. And this is exactly how this literature started. So you look at those, you realize that those possibilities are out there, and then you start to think very seriously what is the cause behind them. And usually there is a reason. So you do find costs and risks and special incentives and constraints which make them there. And this is why I'm showing this to you. Okay? Now, so you observe that these exist. Okay? Yes?
Just to make sure I understand, so the reason that it's weird that they're losing money at the same time as the differentials get larger is because the differential should be a source of money making for them, right?
So we don't know. So we will talk about this in a minute. So we'll try to think about the process, what gives you these stylized facts. At this point, it's just a stylized fact. So, why is it strange? It might be or might not be, depending on how you think about it. It's so at this point, I just want to make the point that they exist, and these stylized facts tend to be true. So basically, they are getting worse when all of the others are getting worse, and they are getting worse when, for some reason, we think that this arbitrage capital is suffering losses. Probably it's not strange, but that's. So here is our plan. Okay, so now finally I will tell you what I will do today. So this is the arc what I want to do. So I want to think a little bit about these limits to arbitrage. The theory what corresponds to these cases, this is what we call limits to arbitrage theories. So I want to start to think a little bit about that how to conceptualize these problems, and we'll talk about limited capital, and we'll talk about incentives of fund managers, and we'll talk about endogenous risk using these very simple models, and that will be probably in the morning, and then in the afternoon I want to start to think about that once we observe certain interesting things about the trading process through these arbitrage models, how can we use those observations to build a new general asset pricing model? Okay? So we want to start to rethink about these covariance terms and the pricing kernel, and we want to kind of think about that if we learn something from these guinea pigs, how can we use that to rebuild it into something more general? And then finally, we'll arrive to intermediary asset pricing, which is something which is quite popular nowadays. So I thought it's a good idea to kind of understand what is going on. And that will be the empirical counterpart of all of this. Okay? And probably what I said at the beginning, you already see here. I mean, there really won't be any making justice to the literature here. Okay, so basically I picked some papers. You see my name a couple of times. This is not an accident. It's not because they are the most important papers on earth, unfortunately. The reason why I'm using those because I understand them the best. I mean, it's my comparative advantage, right? So among the other papers, I understand mine probably better than others. And I find them useful to explain you that how this thought process developed and how it happened. And then if you want to work on some of these issues, which I hope that some of you will decide to do, you just have to do the literature review for yourself. So that's basically the... And I won't even, and probably I should mention that I didn't even make an effort to include all the great papers of those who are sitting here. It's not, and I deeply apologize for that. Okay. Okay, good. So this is what we want to do. Okay. So I want to start with Schleifer and Vishnin, which is basically where all of this probably started, which I don't know, at least what I know of. And this is a very simple model. And basically, the main, the nice thing about this model is that it's actually, I mean, I don't know what you would think. It's not a nice model, okay? So it's actually, you know, you will see that if you try to write a paper like Schleifer, like this paper, and try to present it in your graduate workshops, probably you would get burned quite a bit. This is because of two reasons. One of them, but probably it's not even intended to be a nice model. It's intended to be an illustration of a couple of very interesting thoughts. And this is why I'm showing them. And the second reason is that it's almost 30 years old. So we learned quite a bit since then, and probably we can do much better.
Peter, the other important thing about Schleifer's vision is it was written before the LTCM prize.
Yes.
So there has never been something like that happened.
Yes.
Could we understand what happened to the LTCM by reading this paper?
Yes.
That I think is remarkable.
No, absolutely. So I wanted to, so that's what I meant, is that...
Post-rationalization of LTCM, something we did before the LTCM.
That's right. So I didn't want to, so that's what I meant by there are very, very interesting thoughts here. So that's the reason why I'm showing this, exactly that I think you can understand many, many things which came after, both in the markets and both in theory through this model. So there are very interesting thoughts, and the model itself is not given, but that's fine, you know. I mean, that's why we wrote that's why it started a literature, because everybody wanted to do it better. So, and the LTCM, and probably many other things, yeah. So, okay, here it is. So it's relatively simple. It's more complicated than it looks actually, but it's relatively simple. So here is the idea. There are some arbitrageurs. They are the main actors, and there will be some noise traders, and in the background some investors who are giving money to the arbitrageurs. But really the main guys are the arbitrageurs. And they buy a single asset. This single asset is a unit supply, and it has a known fundamental value to the arbitrageurs. The arbitrageurs know that it should be, the value of this thing should be D. And there are 3 periods, and in a final period, it does become D. So we do know, everybody knows, that at the end it will be D. And then there are these noise traders, so to speak. So in different models, these guys will come up again and again, but they will be called something else. You know, in different models, we call them something else. Here they are called noise traders, and basically what noise traders do, they divert the prices from their fundamental value. They do it in this model by this sentiment shock, so to speak. So they have a downward sloping demand curve, and this downward sloping demand curve is centered somewhere else than the fundamental price. So basically, and then the idea is that we have 3 periods. In the first period, this diversion is known, and then in period 2, this diversion might get worse or might disappear. And even the arbitrageurs don't know which will happen. So this ST is first S, and then in the second period, it becomes either 2S or 0. Okay? So we have these arbitrageurs. They are risk neutral. They have, in the first period, they have some exogenous fund, which is probably not as much as they would like to. But more importantly, in the second period, their funds depends on their performance. So basically, the idea is that if between the two periods they do well, so they will have a high return, then in the second period they will get more money than what they had, while if they are losing money, they will have less money what they had. Okay, so and you know, in the underlying idea is that probably there are some investors in the background who are kind of learning about the skill of these guys, and when they are losing money, they think that they are not good enough and they're taking away their money. That's one story. But in this model, there is no model of that. It's just assumed that this is how it works. So this is kind of a figure of what is happening. So so if there is no intervention, so if there are only the noise traders are setting the prices, then in period 1 you would have the price here at S, and then in the next period either the price goes, well, sorry, it's the price difference, right? So the price should be here. So this is what I will call the price gap. Yes. Why there's no? Okay, so in this point is by assumption. Okay, so basically in the model is by assumption. So there are many justifications in this. So if you read the page,
I do not hear.
The S. So why the prices are not as where they should be. So I think the best way to think about this, at least for our purposes, is that they can come from many different sources in reality. So they might come from indeed some irrationality, but they might come from very rational sources. It might come that there are, so basically what it is some local demand shocks, if you want. So basically it can come from regulations. It might be, for example, if it's long-term bonds, insurance companies have to hold long-term bonds because they have to match the duration of their assets and liabilities. It might come from benchmarks. It might be that, for example, certain mutual funds want to make sure that they are not very far from S&P 500, so they have to buy S&P 500 no matter what. And then they push up the price a little bit too much. It might come from ETFs who have, like ETFs have a certain mandate what they have to do. They have to do it no matter what, so they might distort the prices. So there might be many, many reasons, underlying frictions which validate that. And at least for quite a bit during this talk, we will assume that they do exist. Well, that's exactly what we'll say, right? So we will basically assume that these distortions are there and there are intermediaries who are trading against it. I'm modeling the hedge funds, yes. But you are right, that's the reason. In this class of models, the reason why the hedge funds exist is because these deviations are there.
But somehow all the frictions disappear in period 3.
In period 3, exactly.
Yeah.
Exactly. And that's an interesting fact.
Period 3 is like a payoff period.
Yeah.
This could be period 2 is when the payoffs are realized. So it could be in fixed income, often there's a period when payoffs are realized.
So it could be. So one argument is usually is that in many of these
In derivative securities, there is a payoff period.
so in some sense, so this is actually what will come out in many of these convergence trades is that these are arbitrage trades only in the long term, right? So if you kind of hold on to these securities for the expiration, for the maturity date, then you make money for sure. But the problem is that you might lose your money before the convergence, and this is exactly what the kind of thought is captured here. So this is exactly the idea of this. Where is it? Of this function, that your investors might be impatient with you, and then they might take your money back, or just you are running out of capital, and probably taking these positions is costly. So that's exactly the tension which we're here. So okay, so here we've been. So basically, kind of the idea is that when you trade this arbitrage opportunity in period 1, you are pushing this gap down. So you are pushing the price closer to the fundamental. But then you are facing with the possibility that this mispricing will get worse before it's going down. And then you have this trade-off, right? So the problem is that it's not only that you are that mispricing can get worse, but if it gets worse, you might even lose more money, because then you are making like a negative return here. So probably investors will take back their capital. So you have to kind of try to think about this, that well, what I mean, it's very easy to see what will be the solution of this. So of this trade-off. So whenever the probability of this happening, this red line happening, is very small, probably you go on fully, you put in all your money, you push down this gap as much you can, and then you profit from when the arbitrage disappears, and then you lose in the other end, but probably it happens with a small probability. Even if it happens with small probability, that volatility, so that extra kick to the price, might get worse because you are pushing down the price, right? So you kind of like, so one element what we already see here is that these arbitrageurs, by pushing down the price in period 1, might make the volatility of the price, at least this price change, bigger than it was before. In this sense, they might amplify the volatility, the risk in this arbitrage. Now, if the probability of going up is large enough, then probably you don't want to do that. You will kind of like find a level of pushing it down, and you will save some of your capital for that period, because you want to make sure that you can profit from this really large gap if you can, right? So basically, so if you solve, there is a formal solution here. So what I will do many times, I will kind of give you some ideas how it is solved, and I won't go through the steps. But the steps are on the slides. So when you look back and when you open the papers, hopefully you will be able to work out everything which I said. So at this point, what you have to get from here is that there are two possibilities. One of them is that the probability of this red line happening is relatively small. Then you push down, then these arbitrageurs are going in with all of their capital. They push down the price to some level. Probably they cannot push it down all the way. It will mean that if they are wrong and this probability Q is actually happening and the arbitrage is getting worse, then the change in price is even bigger. And when the probability of Q is relatively large, so there is a good chance that the price goes this way as opposed to this way, then they find an internal equilibrium where they don't push this down, or they won't go in with all their capital. They save some money from here to here, and they invest some here and they invest some here. Yes?
So this story has to be built on the fact that they have a limited amount of capital.
Absolutely.
But if, those arbitrageurs have a limited amount of capital,
Mm-hmm.
And maybe even if we don't have that story, we think that they have a limited, they're trading against the market, they have a limited amount of capital. So what does this explanation add?
Very good, very good. This is exactly what I want to tell you, what it adds. So here is the lesson. So, and this is the lesson what we will take with us. Lesson 1, the constraints of these arbitrageurs today and the constraints of these arbitrageurs tomorrow will determine how much they want to invest today. Okay? So that's lesson 1, which we want to take with us. I mean, you know, the way we do this is that it might look simple here. Hopefully, it will lead to something interesting down the road. Okay? So basically, the main lesson here is that, well, one of them is that even if you know that this arbitrage will be profitable, you might not want to go on in with all your capital, and it's because you are really worried about the future. So you are really worried about what will be the opportunities tomorrow. You understand that it's possible that opportunities will be even better tomorrow than today. So that also keeps you reserved, and it also kind of limits how much you want to invest today. So basically, together, your current opportunities and constraints and your future opportunities and constraints will tell you how much you want to eliminate this mispricing today. Okay, this is basically what we want to.
Even if I can go everything today, but I won't be able to go everything tomorrow, I still want. That's the only difference that I can see.
No, so the opportunities may be better tomorrow.
Exactly. So the opportunities are really good here, right? So for example, if you invest everything here, which will happen sometimes, then it turns out that you are liquidating exactly when the opportunities are the best. Okay, so this is kind of corresponding to your comment, that basically you will see that these arbitrageurs are losing money, and the arbitrage is getting worse exactly when they have limited capital, and this would be the time when it would be the best to enter this arbitrage opportunity. Exactly. So we'll see this in a moment.
That's how the insurance company operates.
Yeah.
Basically what he did, he never said reinsurance. There's a first round of reinsurance that goes on. And Buffett's company never bids on that first round of reinsurance. And he waits for years in which there's a gap, too little capital flowing here, and then he charges a much higher rate of reinsurance. And that's how Berkshire
Basically, so easy. Why would everybody do that?
well, that's
There's no
right
brain in
kind
that.
of money, right? That's
So let's-
kind of capital.
So let's see that. So this is exactly.
Very cheap capital.
Let's see where this goes. So this is exactly the thoughts which are here in the Schleifer-Wishny model. So we see these things are happening to some level. Probably we don't see it very clearly in some respects. So that's why we will go on. Okay, so let's see whether I said that's everything. So the current and expected capital limits can stop arbitrageurs to act on mispricing. Future funds might be based on short-term performance. That's by assumption, but that turns out to be very important in reality. And arbitrageurs might liquidate exactly when expected profits are largest. Okay, so this is the 3 things what I want you to take away from this. So it's a simple model. The mispricing is worsening exogenously. We just assumed it. This flow performance relationship, so the fact that how the investors are responding is coming from nowhere. It's coming from, we just assume that it's there. We have 2 periods, which means that we have very simple price dynamics. But despite its limitations, this paper started several streams of literature. And it's basically every bullet point started 100 papers. That's basically how it works. And first, I will talk about the papers which are about this, pretty much. And then in the afternoon, I will mention some papers which are coming from here. So that's basically how it works. Yes? Sorry, I mean, my eardrums are a bit like because of the airplane.
So
Yeah.
the
Very good. So this is exactly what they do sometimes. So when the probability of, so that's why I said that there are two possibilities, depending on what is the probability of this happening, they might do that. So if this probability, this worsening is large enough, there will be an interior solution where you will invest some and save some more, and you will be just indifferent between the expectations. So that basically will kind of like put this here, right? Yeah, so yes. So basically you either have, so, in microeconomic language, you either have a corner solution or you have an interior solution. When this probability is small enough, you have a corner solution, you go in, and then you suffer the consequences. When you have an interior solution, you go in only a tiny bit, and it still gets worse because somehow you have to be indifferent between these two states, and then you have something in between.
If the probability of going up is in the second period is high enough, you might want to go long, actually.
I think by assumption of the parameters it is not happening, but in principle it could be. Yeah. Okay. So let me show you something, a variant of this, which I think many of these things will come up much more nicely. So here is. So I did this when I was a PhD student. It worked fairly well for me, but that was 10 years ago. So probably you will have to do much better. So that's kind of like that. So this is a. So this is a version of this idea I would argue, in a little bit cleaner way, where we can see some of these trade-offs which we just talked about a little bit nicer. So, and some more ideas will come in. So, it's a similar model, except that now we have continuous time instead of 3 periods, and we have it's an infinite horizon setup, and we just get rid of this flow problem. Okay, that's just too ugly for us. So we throw out this problem of whether there are inflows or outflows. There are no inflows or outflows. You are starting with a certain level of capital, and then and the constraint is that you cannot go negative in your balance. Okay, so this is like you can think of this as, well, it's just a capital constraint, right? So whenever you are losing all your money, you have a problem. So that will be your starting capital, and there will be your remaining capital will be this VT, and this has to be always non-negative. And we get rid of this exogenous worsening of this pricing. So we kind of don't like to assume that it gets worse. We want to know whether it will get worse or not. In particular, we'll work with this setup. Okay? So this is actually, in some sense, a much simpler setup. So suppose that arbitrageurs are not here. Okay? So this is like the autarky. So in autarky, so if arbitrageurs, this is the arbitrage opportunity. Basically, the structure of the opportunity is that as time goes by, the gap, this price gap, remains constant, and then at some point it disappears with a Poisson probability. Okay? So we know that with probability 1 it will disappear at some point. It disappears with equal intensity in any given point, but we don't know when. Okay? But this kind of seems much more riskless, right? So basically there is no inherent reason why it should get worse sometimes. It really looks like a safe opportunity. And indeed, if there would be only one tiny competitive arbitrager, he would make a killing, right? Because you just you take a position and then you just wait. You are not losing anything. So it's costless to kind of just stand here. And then at some point, the gap goes down and you make a lot of money. Okay, so you're short selling this price gap. Okay? And then basically the question is that what if we have all of these competitive arbitrageurs who are acting together? How will they change this price? Okay, so that's basically what we want to learn from this model, is that what will be the endogenous outcome of the arbitraging process? Okay, in the previous one we kind of see something of that, but it was muddled because these S's were going around. It was only 2 periods, so we hope that we will learn something more here. Yes. So this is the investment opportunity. So basically the way, there's only one asset. So you can think of this as a gap asset. Okay, so basically this is a gap asset which has a price of 1, and at some point it will have a price of 0. So basically you want to short sell this. No risk-free asset. Well, there's a storage technology. You can keep your capital if you want. So there is a 0 return risk-free asset if you want. So just, in the background, you could kind of argue that this is, there are 2 demand curves in the background who are temporarily off, but they should be the same. And then with Poisson process, they jump together. But really what you need is just this. Yes? Oh, no, price will respond. Right? Exactly. This will be exactly the question. So basically what we will assume is that there is a downward sloping demand curve in the background. So you take each arbitrager, each small arbitrager takes a position of X. Altogether, they take a position of X bar. This is their aggregate position. And the larger is this aggregate position, the smaller is the gap. So they are pushing it down if they are acting together. If there is only one of them, he is doing nothing with the price. Everybody is a price taker, and everybody is zero mass. So only together they have a price effect. And this is exactly what we want to figure out. We want to figure out that what happens with this arbitrage opportunity once arbitrageurs are trading that. Okay? So just notation. So GT is the size of the gap in a given instant. XT is the individual position, and X bar T is the aggregate position. And basically, it gives a very simple problem. I mean, I was told that I shouldn't say simple so many times because it's never that simple. You should think of this as encouragement. Okay, so I'm trying to that at some point it will feel simple. So so here is the problem. So basically, this is the individual problem. So you are choosing your xt like for every instant, and this gt is basically the gap under the condition that it has not disappeared yet. Okay, so when it disappeared, it became 0. If it has not disappeared, it's some endogenous size, probably smaller than 1, but we have to figure out where it will be when it does not disappear. And this delta is this intensity that it disappears. So it's actually not discounting. This is a probability that it disappears exactly in little t, right? So this is the so if it disappears in a given moment, then if you have a certain position, then you are gaining the jump down, right? So basically that will be your gain. So whatever is the jump down from that point, and you have some capital left or not, right? So this is the capital what you still have, and which is given by this equation. So you start with V0, and then if, for example, this gap is going up, you are losing. It's kind of mark to market, so you are losing continuously, and then something is left, and then you get it.
It is the mark to market. You said there will be no inflow or outflow.
Yeah.
There's an outflow of capital is very important in reality because the market is the market. You have to come up with cash.
Yeah. So
But it's pretty clear.
it's exactly. We are abstracting totally from inflows and outflows.
Yeah, but that's like an outflow, right? The market.
Okay. It is what it is.
Yes.
Yes. so the way we want to think about this is that, okay, so one way to think about this is that in every moment, they are checking that if you are liquidated, whether you still have some money or not. And the constraint is that you always have to have some money. So one way to understand this is like a collateral constraint. You always have to need enough capital to be able to pay for your losses anytime. Yes?
Why is there an interaction between delta and VP?
Delta and this one? Yeah, so basically what is happening is that, so this is a probability that the game ends in period little t, right? So the game practically ends when it jumps down.
The gap disappears and the game ends at the same moment?
Well, you can call it game ends because nothing interesting happening afterward.
And don't I cash in the VP?
So you can cash out there or anytime later, nothing happens, right? So you might as well think that basically the game ends when the convergence happens because there is nothing to trade anymore.
So it's better for me if the game ends when I have much more capital or not?
It is, so this is together your utility, right? So this is your trading gains and this is the capital what you left with. So you can decide not to take any positions ever and end up with V0. That's probably not a super good idea, but you could do that. And then, so you take prices as given, but of course prices are given, this price gap is given by the aggregate position of all of these guys. Okay, so this is what we want to solve, nothing else. Okay? So we want to know what is the equilibrium. So let's do this step by step. Probably I won't show you all the steps, but I will want to give you an idea of what you do. So this is actually a standard continuous time problem. When I did that first, I had no idea about standard continuous time problems, but probably you do because you are better trained than I was. So it turns out that you can solve this with a very standard method called maximum principle or Bellman equation. And basically this is what you get. So basically the first order condition will be this first equation. And it tells a very simple story. And then a second one is telling you that how your value function is developing. And any solution of this game has to satisfy these two conditions. So here is what is happening. So this is a simple derivative. So basically this is exactly the indifference what Darrell was talking about. Basically what this equation tells you is that at any point you have to be indifferent whether you want to invest today or whether you want to save later. It's almost like an Euler condition. And whether you want to invest today or save later depends on the opportunities today and the opportunities in the future. So this is basically a gain, what you can gain today if the gap disappears. This is something like the expected gain of investing 1 unit today. If you save, then you might lose something because if the price gap goes up. On the other hand, you will be able to invest in the future, which is basically captured with this marginal value function. So this marginal value function will take into account what will be the benefit of waiting, weighted by the loss what you might suffer, and this part is just the benefit of investing today. So basically, everyone in this equilibrium will be indifferent whether to enter today or not. And as long this price relationship holds, everybody is indifferent. Actually, it doesn't. There's no axis here, right? So it actually doesn't pin down your positions individually. It just tells you what the price has to be to make everyone indifferent. And if they are indifferent, then you can just back out the aggregate positions which make this price pattern to happen from the demand curve. So the first step you write down these conditions. Second step, you solve these ODEs, which happen to be the simplest possible ODEs on Earth, luckily. And they give you this relationship. So basically, this gives you that how the value develops, and this gives you the price pattern when the gap is not disappearing. And I will show you in a minute what it does, but just kind of like, so basically, this is the starting point. This is the limit of this price gap. And once you have a pattern, you are just picking the aggregate positions which make this happen. So let me show you in picture. So basically what you are getting is that in equilibrium, it has to be the case that whenever the gap is not disappearing, it grows. Okay? So basically in equilibrium what will happen is that a lot of arbitrageurs will invest here, but some will save some money here and invest a little bit less here. Okay? And why is that? Is because you have to trade off the benefits of waiting and saving. If you're investing today, you can profit a little here. However, it will happen with a larger probability. Because if you don't invest today, the arbitrage opportunity might be gone by tomorrow. So to compensate for you to hold on to your money and not to invest today, the arbitrage opportunity has to get better. Yes?
The initial point here is very important. All of a sudden, out of the blue, there's this arbitrage gap.
Yeah.
How do I map this into the real world where most of the time prices are rising? How does it get started?
So okay, so in the TIPS treasury arbitrage, it starts with some convenience yield.
Which is there all the time.
Which is there all the time until well, it fluctuates, right?
So
With time, if we actually take a position like this, like a buy at the position you propose, is buying at 20 years, yes. And in 20 years, will disappear.
So 20 year in will disappear. This is not really our.
no, the begin, but I'm asking about how do you turn it on? What's the system to turn it on? The original arbitrage gap was not maybe 1, maybe it was half and quarter. That's
So-
how it's missing from.
So I think the way to think about this is that these local frictions, which, for example, convenience yields, for example, the need of insurance companies for long-term bonds, and so on, all of these frictions are making these gaps fluctuate. Fundamentally, they make this gap fluctuate, right? So if arbitrageurs are not there, you get these imperfections coming and going. This is a simple model. It's here we say that let's suppose that they are there and then they disappear completely. Most probably in reality, they halve, then they double, and then if the arbitrager want to trade on that, he has to do something with this uncertainty. So in the long term, they disappear completely. I mean, if you hold until maturity, in some of the cases, it disappears completely. But probably for the arbitrage, the relevant thing is the short term. The fact that the underlying fundamental tension in prices is changing over time. Yes?
Do I understand correctly that in order for the price gap to get reversed over time, some of the arbitrageurs need to be selling the arbitrage?
Exactly. So the way is,
What makes that individually rational, given that they can't lose money from
well, the problem is that they have this constraint. So they are. So when the gap is doing that, so they have to mark to market or collateralize their positions. I mean, probably I like the idea of collateralization. Probably that's kind of the easiest to think about. So basically, you have to collateralize this loss, and effectively you are losing that money when the price goes up, and at some point you might run out of funds. Now, in this equilibrium, it can go different ways. So as I said, individual positions are not determined. So you can think of these two ways. One of them is that every arbitrager does the same. And then they are never running out of positions. They are just taking smaller and smaller positions as their capital is decreasing. Or you can think of this the Buffett way, that some of these guys are early traders. They go full in. And when the price gap goes up, just as in Schleifer and Vishny and just as here, you lose and you have to liquidate. And then there are some others who are getting in later and benefit from the fact that the first guys liquidated. Yes?
Entry of new guys, over time you would get stronger and stronger, both because the gap is getting bigger and because they have more time to gather together the necessary resources to force.
Slow-moving capital. Yeah. Here it goes. Yes. Yes. So in this model, I'm not thinking about that, right? So basically, in this model, I'm saying is that everybody starts with V0, and then you do whatever you do, but there is no sense of money coming in. But of course, in reality, that's a very relevant and important issue. So what is the point here? Okay, so what is the point here? So the main point here is that arbitrageurs are creating their own losses, so to speak, right? So fundamentally, there was no reason for this arbitrage opportunity to get worse. We did not assume that. But just the way traders are trading, they are creating their own losses, because otherwise you couldn't compensate those who are waiting. And if you cannot compensate those who are waiting, nobody waits. If nobody waits, then it will be extremely profitable to wait, right? So, you know, so let's just play a little bit with that. So suppose that instead of this equilibrium, where the positions are going down and down and down, everybody invests here all their money. Then what is happening is that by here, they lose everything. The gap goes here, and then it gets flat. And then anybody who instead decides to wait until here will make infinite profits, because there are no possible losses. You don't need capital to collateralize your potential losses. You take a very large position and just hold on to it and wait until it disappears, right? So it's one thing what you can easily show is that there cannot be flat parts in this curve.
Suppose one are trading in the beginning. They
Yes.
just trade all the capital.
Yes.
And everybody knows what everyone is doing.
Yes.
Then the gap will not widen, right? Or just, what am I missing?
Okay, so the only way you can make this, okay. I didn't want to give you too much details, but you are pushing it. Okay. No, that's fine. No, it's good. I just kind of thought that I will spare this. So there are multiple equilibria here. Okay, so I didn't mention this at this point. So there are multiple equilibria. It happens that, so basically this thing. So this is the equilibrium, and as you are picking G limit, you are picking different equilibria. Almost all equilibria has this same S shape. Okay, so almost all of them have this increasing shape, except one. One equilibrium is that you pick this to 0, and you have a 0 gap. The problem, that would be kind of the standard.
Everyone traded at the beginning.
It's not the beginning, that's the thing. So that's what I wanted to mention. It means you are trading forever. For that, to keep that gap at 0 for a very long time, you have to be ready to take a very large position for a very long time. Okay? So basically there's this tension. So in this model, there is this tension. You have to.
There's no risk, right?
Exactly. So if you can convince everyone to do that, that can be an equilibrium. The way I select only one of these equilibria, which is the one which I showed to you, is to introduce a tiny, tiny, tiny trading cost. So if you introduce arbitrary cost of holding position, that zero disappears. Because that might be, the fact that you have to be ready to potentially keep that position forever is, even with epsilon trading cost, is infinitely costly. And you have only limited capital.
You're talking about holding costs, not a trading.
Yeah. Short. It's like, for example, a shorting fee. So I kind of focused on the unique equilibrium under this scenario. But even then, even if you don't like that, I think the fact that all of these equilibria exist is quite interesting. So it's not, I don't want to insist on the unique one, but that's, yes.
So when you say there are multiple equilibria, do they give rise to the same price path?
Exactly. So basically
Just different trade.
Oh, that's also true. That's also true, but I didn't even went there. So even if you call this one equilibrium when only they differ by the trading position, even then there are multiple equilibria. Because basically what you do is that you can fix one limit of the gap, and then that's basically a limit condition on your ODE, and then you solve from there and you get like a pattern. And then you can get rid of some of these equilibria, but in principle there are many. If you are happy with this perturbation, then there is only one. But this is not, so here is the main point what I want to show you about this. So it's a very stylized model. It's not clear what to do with that. So one way to kind of think a little bit about this is to check that what is the predictability property of the gap after trading. So remember, an arbitrage opportunity, the inherent thing about arbitrage opportunities is that they are supposed to be predictable. You know that you have a gap, and then later you won't have a gap. That makes it very predictable. That's why you want to trade. So a weaker thing to say them is probably they are not riskless, but they are predictable. Okay. Now you can check that what is the predictability of this gap in this model, and basically what you will find is that if you keep increasing the initial level of capital of these arbitrageurs, it converges to a martingale. So basically, at some point, if there is enough capital in this system, it will start at almost zero. It goes up to G star, and in every point, the loss which you can suffer because the price going up exactly cancel out the gain what you can gain if the price disappears. So it becomes an unpredictable trade. It becomes a random trade. It was like a sure, safe opportunity, and it became a random trade. And I think that's kind of the really important lesson from this, is that we think about arbitrage as a way to get rid of a price gap. But actually, an equivalent way of getting rid of an arbitrage opportunity is to make them unpredictable. And I think many times this is exactly what is happening with these arbitrage opportunities. So it's not that, so probably from the point of view of the trader, this is actually not a very predictable opportunity, right? So in long term, it should make profit. But in the short term, it can go up and then you lose, or it can go down and then you can gain. You don't really know, and that kind of stops you from trading. So it's basically what it says is that no arbitrage and efficient markets are not the same. You can eliminate the arbitrage opportunity by making it not predictable. Now, for our and this is what is happening here. Now, for our purposes, before we conclude, let me open this up a bit. Okay, so this was about arbitrage opportunities, but actually, what I want to talk about in the afternoon are just asset pricing. Okay, so what do we learn? What can we use from these models for building up an asset pricing model? And here is what I will claim. So what I think what we can see is that financial institutions can profit from trading against local demand shocks. So probably that's not a very bad picture of what they are doing, right? So we have all of this hedge fund smart money, and the way they make money is to trade against local mispricings, which are there for some reason. And they don't have to be arbitrage opportunities. It's just they're trading against local demand shocks, which make some stuff too cheap, some stuff too expensive. And they're in these models we call them arbitrage opportunities. Financial institutions call them arbitrageurs, but in general, probably it's just what they are doing. But their positions will depend on their capital and their opportunities today, and they will depend on their capital opportunities in the future. So they will basically trade off what they can trade in the future with that unit of money and what they can trade today with that unit of money. And if you think about this, it's not very far from an Euler equation, so probably we can do something with that, right? So we can probably will be able to build some kind of real asset pricing out of these thoughts. And the way I will proceed that I will say that this thing here, this trade-off will give some kind of an effective risk aversion for these financial institutions. It might come from utilities, it might not come from utilities, but at the end of the day, they will want to ask the question is that what is the value of this particular dollar which I'm not investing today but saving for the future. And when this value is high, I will look as I would be very risk averse. And when that value is low, I will look not very risk averse. So there will be some kind of object like effective risk aversion. However, this is not the end of the story. Yeah.
Can you go back a couple slides to your value function? So you should take your equilibrium, okay? Your value function is going to have a positive value, right?
Yeah. Yeah.
So what you're saying in some sense is that these guys are like eliminating arbitrage. That's what they're doing. So the arbitrageurs are the guys who eliminate the arbitrages. After they come in, from then on, they don't get any more value, right?
Except that there is another opportunity somewhere else, right? If there's another opportunity somewhere else.
No, if there were somewhere else, but for this one.
Yeah, I agree with that. But we wanna exactly. But we wanna zoom out.
Your value that they are optimal here, and then you don't.
Yes. We wanna zoom out, and we wanna think about this. Yes. So in this model, that's completely right. So. But what we will do in the afternoon, it's actually not the afternoon, right? It's still the morning. So in a couple of minutes, what we'll do is to open this up and think about them trading not only one opportunity but many different opportunities, and not riskless opportunities but risky opportunities, right? So anything they can trade, there will be this, but this thought we want to take with us, and it's not only that. Let me give you a little bit more complication. So if you think about this, if you start to think about the equilibrium, things are getting a tiny bit more complicated. Because basically, their aggregate positions will give asset prices and returns, right? Once we are making this like a pricing model, which will determine their future capital. Because when the returns are high, probably they will get richer. When the returns are low, probably they will get poorer. So it will determine their future capital and opportunities. And we just said that these future capitals and opportunities will determine their current effective risk aversion. And that effective risk aversion will determine aggregate positions. So we will have to think about this as a system, as an equilibrium, where capital, the dynamics of capital of these intermediaries and asset prices and returns are jointly determined. Okay? And that's what we will call like a closed equilibrium model. So this will be the question for the next part. Can we make it a general asset pricing model which describes the expected return on any assets? And then later, that's probably a wild hope, we can probably even test it on the data and try to figure out whether it leads to somewhere or not. And that's what we will call intermediary asset pricing. Thank you. That's right? That's the time.
I'm the chair.
Yeah. I was right with the time, right? Yeah. Okay, good. Yeah, I just want to make sure that I'm not half an hour off or half an hour. Yeah. Okay.